All right, how we doing, people?
Woo!
Welcome to another market update. Let's kick things off with a summary of the stories I'll be getting into today, starting with U.S. 30-year fixed mortgage rates broke 7% ahead of the next Fed meeting.
For real? You fuck with that?
No, we do not. New home sales in the U.S. took a dive but beat expectations.
Nice.
Google, or Alphabet, fell 8% after some disappointing earnings.
And we say bye-bye.
The Bank of Japan's suspected FX intervention fails to fully rein in the yen.
Come on, man.
At least for now. Newly elected UK Prime Minister RISHI SUNAK pledges to lead Britain out of economic crisis.
Right.
Saudi Aramco says the global energy transition is flawed.
You're a fucking idiot.
And Bitcoin miners are under serious pressure from the difficulty adjustment. Don't worry, we'll get into it. But before I do, let's go over a quick recap of last week. So last week, U.S. inflation came in hot at 8.2% for headline CPI and 6.6% for core.
God damn!
Something like a 40-year record. U.S. housing permits caught a little boost, but housing starts slowed down significantly. Aww. Probably because of those interest rates. UK inflation hit 10.1%, and the Bank of England is trying to rein in some of its government spending.
Oh, hell no!
The Bank of Japan warned it will intervene in the FX market again if necessary, which it looks like it did.
Not crazy.
China calmed its markets leading into President Xi's re-election. The U.S. was considering selling more oil from the SPR to combat gas prices.
No!
And with the recent spike in gas prices, which I'll get into, it's almost a guarantee. And then finally, MasterCard is helping banks offer cryptocurrency trading.
Oh my god, who the hell cares?
That's fair. All right, with that out of the way, let's get into our first story. So it's going to be mortgage rates hitting over 7%, which is pretty freaking wild, especially with the move, just because it's been so fast. So they actually peaked at 7.6 or 16%. They've come back a little bit, so I have the chart right here. They're about 6.94%, which is still ridiculous, so just call it 7 to round up. But that is not good, just like I said, mostly because of the rate of change, just how aggressive it is, but also just in, an absolute term, just because people cannot necessarily afford a home when interest rates are that high. So the average interest rate on the most popular, that's a key point, most popular U.S. home loan rose to its highest level since 2001 as tightening financial conditions weigh on the housing sector. Mortgage rates have more than doubled since the beginning of the year as the Federal Reserve pursues an aggressive path of interest rate hikes to rein in stubbornly high inflation.
Totally.
The central bank is expected to continue raising rates by 75 basis points for a fourth straight time at the conclusion of its next policy meeting on November 1st to 2nd. That could be partly why we're seeing rates go up, just in anticipation of that additional hike. We'll see if they retrace or how the market reacts, but as long as the Fed keeps hiking rates, the mortgage rates are essentially a derivative of their rates. So if they keep rising, mortgage rates are almost certainly going to rise in tandem. So as long as they keep rising 75 basis points, and I believe the expectation is maybe like a 50 basis point hike after that, although who knows, it's always changing, then mortgage rates could, who knows, get to 8, 9, even 10% by the end of the year.
Not crazy.
So getting back into it, those sanctions designed to cool, or those actions, sanctions.
You're a fucking idiot.
Those actions designed to cool the economy sufficiently to curb price pressures have weighed heavily on the interest rate sensitive housing sector, as expectations for the Fed tightening have led to a surge in treasury yields. So I guess to keep in mind, it's not just interest rates for mortgages. Obviously, that's a huge thing, but yields across the board. I mean, the whole yield curve is just getting demolished. We're seeing the 10-year broke over 4%. The 3-month treasury bill is, I believe, almost as much or more. I think it's basically in line with the 10-year and 30-year. So you get paid as much to lend your money to the government for 3 months as you would for 30 years.
What?
Doesn't make a whole lot of sense. I know. But yeah, just wanted to highlight that just because this is a big deal. I mean, especially if you were interested in buying a home or have a home, looking to sell, buy, whatever it is, because this is dramatically reducing the amount of leverage anyone can get, which in other words means it's dramatically reducing the value of a home that someone can buy.
Totally.
All right, with that out of the way, let's transition to, it's another home-related story. So new home sales in the United States fell 10.9% from the previous month to a seasonally adjusted annualized rate of 603,000 in September. And this was after jumping 24.7% in August. So you can see this chart right here. So the July new home sales were 543,000, and then we had a pretty significant jump, 24.7% to 677,000. But we have now had a pretty sizable retracement to 603. Now, take all this with a grain of salt. Who knows? But I thought the jump previously was a little interesting, maybe related to people trying to sell their homes. Just knowing that mortgage rates are going to rise, you probably got a lot of panic sellers. I mean, it's hard to have, I guess, a panic seller for homes just because it's not exactly super liquid. You can't just sell your home overnight.
Yeah.
But either way, so we had that jump, and now we're starting to retrace. So next month, if we see an even larger retracement, maybe back into the 500,000 starts, that'll definitely be a sign that this housing market is under some serious pressure. All right, so let's transition to our next story. We got Alphabet. Had some pretty disappointing earnings, and they fell 8%. Actually, let's go to the chart real quick so we can see it. So you can see this pretty big drop, and if you go to the candles, you can actually see it was pretty much just a straight gap down from the opening price of that candle to the current price, I guess, about 6%, but to the bottom, about 8%. Nevertheless, for a big company like Google, that's a huge deal. But the shares of Alphabet dipped as much as 8% Wednesday morning, a day after the company released third quarter earnings that missed on the top and bottom lines. Revenue growth slowed to 6% from 41% a year earlier.
God damn!
As the company contends with a continued downdraft in online ad spending. Now, the main reason I wanted to bring this up was because if a company like Google, the biggest company who is by most people, like the way most people view Google is they just print money. Like they are an unbelievably effective cash generating company, and if they are struggling and their revenue and all these other metrics, financial metrics, are struggling to compare to previous years or whatever, they are probably a good proxy for the rest of the economy. Because if Google can't make it, who can? So in other words,
And we say bye-bye!
but yeah, so shares of Alphabet dipped as much as 8%. Alphabet reported its weakest period for growth since 2013, except for one other period early in the pandemic. But the revenue slowing from 6% to 41% is huge, or from 41% to 6%. That's huge. And like I said, this is potentially indicative of other companies struggling, because if Google can't make it, who the hell can? All right, well, let's keep the ball rolling. Let's transition to Japan and their intervention in the FX market, trying to backstop the yen. So Japanese policymakers on Monday continued efforts to tame sharp yen falls, including through 2 straight market days of suspected intervention. Now, they haven't explicitly said it. They're kind of playing this, being coy a little bit, like, oh, we could intervene. We're going to intervene. We're not going to tell you if we are. But for the most part, you can tell because a lot of people are watching their treasury holdings, which is what they would presumably be selling to buy yen to support the USD JPY pair. So they sell their treasuries, and people are watching their treasury balance dwindle. Also, when you're looking at the market and you see the moves, it's pretty clear that there is a huge player that realistically has to be some sort of sovereign, i.e. Japan. So now there's been a little bit of an update since this article, because they're saying the intervention ultimately failed to prop up the currency against the persistent dollar strength. But yesterday and today, the dollar, I guess for the last few days, the dollar has been retracing pretty significantly. Now, that doesn't mean that this is really working, and I still think this is probably more of a pullback unless something really changes in both respective monetary policies, that is the US and Japan. I don't really see stuff changing. I mean, maybe the people start front running it because they think things are going to turn around. But actually, let me go to the chart real quick so you can see. So this is USD JPY. Actually, go down to the hourly chart. So maybe the 4 hour. So this was basically the suspected intervention or actual intervention, this huge candle right here. And so we're almost at a new low from that like actual low point of the wick. So it's possible that the market is shifting, at least in the short term. But nevertheless, I still think it's probably not going to be sizable unless something really significant changes with both respective central banks. So the yen sell-off is hurting the world's third largest economy by driving already surging imports and challenges the Bank of Japan's commitment to ultra-low rates, its yield curve control, in the face of rapid global monetary tightening to combat rampant inflation. And this is Masato Kanda, or Kanada, I'm not really good with these names, who's vice finance minister for Japan. And he says, we won't commit... what is this? We won't comment. Sorry. I can't read apparently. So he won't comment. Like I said earlier, the Bank of Japan and Ministry of Finance, they're kind of playing this weird game where they don't want to let the market know when they're intervening, but they're saying that they will when needed. They're trying to be a little discreet about it. I think they like the fear or the uncertainty because it helps regulate the yen moving one way or the other, or I should say moving against them, because there's always this fear that they're going to intervene at any time, rather than like, oh, okay, we're going to intervene when the yen hits this level or at this date or something. And so in my opinion, this is a way for them to tame the market, at least their approach to tame the market a little bit more.
Totally.
Continuing the quote, we are monitoring the market 24/7 while taking appropriate responses. We'll continue to do so from now on as well. Yeah, so in this particular person from the Bank of Japan, he oversees Japan's exchange rate policy, so he's being very non-committal, and obviously his opinion is important in this. But yeah, I just wanted to touch on that because this is a huge deal. A lot of people maybe don't focus too much on currencies, but right now, I would say currencies are more important than they really have been, maybe ever, just because we're in the middle of a potential sovereign debt bubble bursting, and you got yields rising, you know, for U.S. Treasuries, the global collateral of the world. And basically, when those yields rise, you're going to get margin calls on all these different countries, and we're also putting pressure on their currencies with the dollar strength, partly related to yields rising. So the yen is under serious pressure, and I mean, this is like the third biggest currency in the world, and it has just been depreciating rapidly, and I don't think it's quite got to the level where their economy is bordering on just like disorder, but it's definitely getting there. And, you know, hence the Bank of Japan starting to intervene. I mean, this is now their second intervention. If I go back to this chart, this right here was the first one. You can see this huge candle, but it didn't do much. Obviously, we just kept going higher. And now this is the second suspected, I guess, quote unquote, suspected intervention. And we haven't pulled back, headed higher, you know, to that previous high, but, you know, we are retracing back to the low. So it's possible that maybe the market is starting to get a little bit more concerned about the yen's intervention, or the Bank of Japan's intervention into the yen, just because they are, you know, they're going to be doing it more often, I would imagine. Like the higher the exchange rate for USD JPY goes, the more likely they are to intervene, because at those higher levels, it starts becoming much more of a problem.
Right.
All right, what's our next story? Okay, let's talk about RISHI SUNAK. I think that's how you pronounce it. I'm not really good with names. So I actually got a quick video that we can listen to real quick. Let's go ahead and do that.
RISHI SUNAK is therefore elected as leader of the Conservative Party.
A history-making moment amid the chaos of British politics. The country's first British Indian Prime Minister, RISHI SUNAK, meeting with King Charles this morning. Britain's new leader is the third Prime Minister this year and facing a massive challenge. The pound sharply down against the dollar, inflation surging, and borrowing costs through the roof.
There is no doubt we face a profound economic challenge. We now need stability and unity.
At 42, Sunak is the youngest British leader in more than 200 years and the country's first leader of color. A former finance minister, he's won praise for his economic policies.
Borrowing your way out of inflation isn't a plan, it's a fairy tale.
But he's expected to oversee huge spending cuts to balance the books, an unpopular move, especially given his wealthy background. The son of Indian immigrants, Sunak was educated at Oxford, then Stanford, going on to earn millions as a banker and marrying the daughter of a billionaire Indian tech giant.
It's always going to be a problem for the Conservative Party being seen as the party of the rich.
Sunak's predecessor, Liz Truss, lasted only 44 days in office, pushed out after her economic plans blew up Britain's finances. Her predecessor, Boris Johnson, forced to quit after a series of scandals. The British public totally fed up.
I think we're a laughing stock now.
What an absolute farce all this stuff is.
But with no election until January 2025, many voters just hope Sunak won't be as bad as his predecessors.
Richie is not an angel, not by any stretch of imagination, but is the best of the lot.
Along with all those domestic issues, of course.
All right, so for those who don't know, hopefully by now you do know that Liz Truss, the previous prime minister of 6 weeks, didn't outlast the lettuce. That might be out of context if you don't know, but people were betting that lettuce, a literal head of lettuce, would outlast her. I think they were like videotaping and everything, like recording this lettuce, and it literally lived longer than Liz Truss, which is pretty wild. Almost impressive, right? But anyway, this guy right here, Rishi Sunak, is the replacement, and obviously everybody's hoping that he can kind of get the Bank of England's, for lack of a better term, shit together, because they've been in complete disarray. So there's a lot to say about this guy. Now, one of the reasons I would say that he's gotten some support is that he talked about Liz Truss's financial plan, about her spending, and like basically her way of combating the issues, most notably inflation. It was a fairy tale. You probably heard it in that video. And so his criticism of her plan, especially now, with hindsight, that it did not work, it blew up, I guess. It added some level of credibility to him. Also, he is a former hedge fund manager. He's like one of the richest people in Parliament, like $700 million net worth. So, and not saying that's a good thing or that makes him qualified, but people, I guess, maybe are assuming that he at least knows how to handle money or whatever, so maybe he can get their finances back in order. But I'll go ahead and read this article a little bit. So Rishi Sunak became Britain's third prime minister in 2 months, fucking wild, on Tuesday, and pledged to lead the country out of a profound economic crisis and rebuild trust in politics. Sunak quickly reappointed Jeremy Hunt as his finance minister in a move designed to calm markets that had balked at his predecessor's debt-fueled economic plans. The stuff he called a fairy tale.
Little bitch.
So Sunak said difficult decisions lay ahead as he looks to cut public spending, basically do like the opposite of Liz Truss. Hunt, his finance minister or whatever, who Truss appointed to calm markets, roiled by her dash for growth, has been preparing a new budget alongside borrowing and growth forecasts due out on Monday, and repeated his warning on Tuesday that it is going to be tough. So obviously they are far from, out of the woods yet, but hopefully this guy can get their house in order, because, just having this revolving door of prime ministers at a time when you really need some level of leadership is not good. During less chaotic times, it maybe matters less, but in times like this where you really need a leader taking action and solving stuff, someone who understands finances, because the pound and the gilt market just having so much volatility and craziness about them. Hopefully this guy gets their act together, and I would say it's maybe more likely than not, just given his experience in finance. But at the same time, he's a politician, so you can't put it past him.
Totally.
All right, so let's transition to the next story. We got Saudi Aramco. So it's a recent story. Oil giant Saudi Aramco launched a $1.5 billion fund to support an inclusive global energy transition on Wednesday, while Saudi officials said the switch from hydrocarbons could take decades, necessitating continued investment in conventional resources. Now, this has been a major critique of, my own critique, I guess, but of a lot of people, of the overall green agenda or movement is everybody is just so quick to throw the baby out with the bathwater and basically just do away with anything fossil fuel related. Just stop investing, completely just flush it down the drain, despite us being so heavily reliant on fossil fuels and hydrocarbons. Still, I mean, even if we transitioned all our electricity to renewable sources like wind or energy, which is not happening anytime soon. I mean, right now they account for like it's like 3% of global energy. 3%.
Not crazy.
So we have a long way to go if they're gonna take over electricity. But even if they got 100% electricity, there is still something like 30% or more of our energy use goes to transportation, which renewables cannot tackle them. You're talking about large ships, planes, like diesel trucks, all this transportation, manufacturing for high heat in various manufacturing, like for steel or something. They need hydrocarbons to accomplish that. This whole idea that we're going to be like net zero or completely get rid of hydrocarbons, fossil fuels, coal, oil, natural gas, whatever you want to include in that umbrella is absolutely absurd. I mean, it's not to say that we shouldn't do it or get there, but we need to take the appropriate steps and understand, like recognize the reality of the situation, that we aren't going to be able to transition out of, away from this that is so like inextricably intertwined with our economy and our way of life, that, hydrocarbons and fossil fuels. We can't just depart from that overnight. We have to build out the infrastructure for the alternatives, and that is also going to require us to continue investing in fossil fuels, refineries, drilling sites, whatever it is, until we're able to meet that transition. Because if we stop investing now because of, this ESG agenda, it's only going to hurt us even more. We're just going to dig our own grave, because we're basically going to create even more of an energy like supply constraint just from underinvestment than we already have. And, it's just going to create problems. We need to be realistic about this. Like, everybody just wants to, like, quote unquote, save the world without really understanding the situation and our needs for energy. So with that rant out of the way, let's continue. So Saudi Arabia, the world's top oil exporter and fellow OPEC producers, have warned of underinvestment in fossil fuels, especially while spare production capacity is thin. Now, that's partly because of underinvestment leading it up to this point. So it's not like it's just an issue now. We have been underinvesting for a long time, and that's partly why we're in this energy crunch. So the current transition plan is flawed, honestly. This is a quote. It is not really delivering. What we need is an optimal, realistic transition plan. And this is the CEO of Aramco. So we need to realize that today, alternatives are not ready to shoulder a heavy load of the growing energy demand, and therefore we need to work in parallel until alternatives are ready. So kind of back to what I was saying, this point about work in parallel, we are trying to basically just substitute renewable energy sources for fossil fuels, rather than like building them out as a parallel system. That way we can transition, because we're basically just like turning off the fossil fuel end and trying to turn on the renewable end, when the latter, the renewable end, is not capable of meeting our energy needs. So we need to continue investing and working with the fossil fuel end of our energy sources until we're able to actually make that transition, because we're not even close, and that doesn't mean we shouldn't. We just need to be realistic about the situation.
Yep.
All right, last little bit. Saudi Arabia and fellow Gulf Arab states have sought to bolster their green credentials. Riyadh last year said the kingdom aims to reach net zero emissions of greenhouse gases, mostly produced by burning fossil fuels, by 2060. Now, that number is a lot more realistic than some of the other ones, like California, I think, has like a 2030 net zero policy, which is absolutely ridiculous. I thought it was ironic because they were talking about transitioning entirely to EVs, or basically not some law in place where you're not even allowed to sell EVs after 2030, I think. And a day after, they were telling people to stop charging their electric vehicles because it was putting too much pressure on the grid.
You're a fucking idiot.
So that's California for you. Basically saying you have to get an electric car, but our grid can't handle it the next day. So that's a huge deal. because, I mean, you're not going to make that transition if you can't even support the transition you're telling people to make. But anyway, moral of the story, underinvestment, been a problem in oil, leading to issues, and we need to be realistic about energy and continue investing in the energy we need until we can fully make that transition. And I was actually surprised to read that Saudi Arabia is making a commitment to net zero by 2060. Now, more realistic goal, but still, given that they are obviously an oil-centric nation, I mean, that is like literally how they make money. That's like their only good quality, I suppose. And they are committing to net zero. I wonder if they have plans to build out some sort of green energy, because in some sense, that's almost like putting their country out of business. But either way, still interesting.
My man!
All right, so let's transition to the final story. So we got our crypto story. Now, this is a very interesting story, maybe a little bit high level, not super high level, but you'll get what I mean. So basically, Bitcoin right now, as for those who are watching, I'm sure a lot of people know the price, track it a little bit. It's been, roughly around 20,000 after a very sizable drop from, the peak at 69,000. But one thing that has been very, I shouldn't say unusual, but it's, I guess just putting pressure on miners, because right now the hash rate is reaching all-time highs. And when the hash rate goes up, the difficulty adjustment goes up, which basically means that miners make less money. And when the Bitcoin price is going down or not going up or just this low, while the hash rate is literally making all-time highs, all these inefficient miners, I guess, like miners that their cost of production, like their energy inputs, because that's, the primary expense for Bitcoin miners, their energy expense is too high, and so they're not going to be profitable, and they're going to get like their own version of a margin call, which means they have to sell either their collateral in either the form of ASICs, so the specialized computer systems, the mining rigs, or by selling Bitcoin on their balance sheet. And this isn't a bad thing insofar as it weeds out the inefficient miners, the bad miners, whatever you want to call it. But it can put downward pressure on price, because you have all these miners that can't afford to mine having to sell their assets. Now, like I said, they could sell their actual mining rigs to get money, to raise capital, or they could sell Bitcoin on their balance sheet. Now, the former doesn't necessarily have any implication for price, but the latter, selling Bitcoin, obviously can. This isn't to say that we're going to have like a huge drawdown, but it is a headwind to keep in mind. So over the weekend, Bitcoin mining difficulty saw an upward adjustment of 3.44% after the previous adjustment of 13.55, pushing mining difficulty to yet another all-time high as hash rate continues to soar. The rising hash rate dynamic seen throughout 2022 while the Bitcoin price has fallen has put a lot of pressure on both public and private mining operations. Throughout the year, we have seen public miners capitulate on their Bitcoin holdings as diminishing revenue and treasury values have placed increasing pressure on balance sheets. At their peak, public miners' Bitcoin holdings reached over 46,000 Bitcoin, but have since fallen 26% as Bitcoin treasuries were sold out of necessity to access more capital, pay down debt, and fund operations and expansion plans. So when they get squeezed, they have to sell their assets, right? And if they're not making enough money from mining, because the Bitcoin price isn't going up, because that's part of the reward, right? When you mine, you earn Bitcoin. So if the price of Bitcoin in dollar terms is low, you're not making as much money. So when the hash rate goes up, or the the difficulty adjustment goes up because of more miners joining the network, then you're getting basically, with Bitcoin trading flat, you're just getting your profit margin squeezed tighter and tighter until maybe you are breaking even, or you're losing money, in which case you might have to sell your assets. So last little bit, as hash price continues to trend to all-time lows, the probability of a minor capitulation or liquidation event probabilistically increases until a drawdown in hash rate, as certain entities cease mining and liquidate their assets in the form of both Bitcoin and the mining rigs.
Damn!
So this is not unusual. This happened in 2018, I believe. I'm pretty sure that was actually the title. Yeah, so risk-facing Bitcoin market in repeat of 2018 cycle. This is, I would say, more of a, well, in the short term, not necessarily a good thing for price action, but in the long term, it's good because you're weeding out the inefficient miners, the ones who are just on the cusp of profitability because they don't have the lowest energy costs or the most efficient machines. And so it kind of purges the network. It's like a natural market force that purges the network to make it more efficient and just keep ensure that the better miners are in there. It's kind of like the idea of a like a bull market raises all ships, and then when the tide goes down, you find out who's naked. So right now we're about to find out what Bitcoin miners are naked. All right, well, that is all the stories I have for you today. But before I get out of here, let's go over what we can expect or look for next week. Whoops. Okay, so next week got a lot going on. Most importantly, perhaps, tomorrow on Thursday, ECB interest rate decision. The current rate is 1.25%, and the forecast is a 75 basis point hike to 2%.
My man!
And we have U.S. durable good orders. The previous month was minus 0.02%, and the forecast is a positive 0.2%. And then another big one. And then all this is on tomorrow, Thursday, by the way. So U.S. Q3 GDP numbers are going to come out. Obviously, a huge metric. So previous quarter was minus 0.6%, and the forecast is a positive 2.5%. Woo! Now, I've heard a lot of people talking about the GDP numbers for this quarter 3 being positive, largely because of like this inventory glut. But a lot of projections are saying that after this, we're going to see, basically the recession come again. It's like double dip idea where we get the 2 negative quarters, we get a positive one, everything's we're out, and then it retraces. But I'd have to look more into it because I was just hearing some people talk about how these numbers might be a little bit misleading because of something related to inventories. But either way, it'll be important to watch to see exactly how good or bad that number is.
Totally.
All right, and then again, also tomorrow, the Bank of Japan interest rate decision. So the current rate is minus 0.1%. They have negative rates, and the forecast is holding it flat at minus 0.1%.
Not crazy.
Because they are engaging in yield curve control. They're pinning their yields at negative right now. Their like base interest rate, the 10-year bond, their 10-year is pinned at 25 basis points, so slightly positive, although not in real terms because of inflation. But yeah, so obviously the expectation is that they're going to stay, remain steadfast in their yield curve control, but who knows? Maybe they surprise us, in which case I would say that USD JPY drops dramatically. If they change their tune at all, the yen is going to, or I guess the dollar is going to crater against the yen, at least temporarily.
Whoa.
All right, and Friday, we have inflation numbers for Germany and Italy. We also have U.S. personal income and spending for September. And then Monday, we get the European area Q3 GDP numbers. The previous quarter was a positive 0.8%, and the forecast is negative 0.01%. And then we have also on Monday, European area inflation numbers. So the previous month was 9.9%, and the forecast is a 10 handle, 10.1.
God damn!
So we'll see if that comes to fruition. All right, well, that is all I have for you today. But as always, stay happy, humble, and most importantly, solvent. And I'll catch you all next week.
And we say bye-bye!